Are bank stocks good investments, or are they not worth it? The biggest risk in investing in individual stocks is that they can go bankrupt and the stock price could go to zero. But for banks, especially the big ones, the odds of them going to zero has all but disappeared. Since the financial crisis of 2007 and 2008, banks are considered too big to fail, backstopped by the federal government. In other words, if a big bank gets in trouble, they're too important and too vital to the entire financial system that we're going to bail them out. So because of that guarantee by the taxpayers, do bank stocks make good investments? The big four banks are what I'll focus on in this video: JPMorgan Chase, Bank of America, Wells Fargo, and Citigroup. Together, the big four have a combined market cap of nearly $800 billion. But does that mean anything? At the end of the day, it all comes down to stock performance if you're someone who is a long-term investor. When compared to the broad market, which has risen 54.57% over the past 5 years, the banks have fared worse. JPMorgan Chase has risen 23% in the past 5 years, with Bank of America up 36%. But Wells Fargo and Citigroup have fallen 19% and 32% respectively over that 5-year period. But what about since the end of the financial crisis in 2009? The broad market has risen 489%, with only Bank of America beating that at 800%. JPMorgan Chase has risen 392%, Wells Fargo has risen 263%, and Citigroup has risen 170% since the 2009 bottom. So does that make the big banks a worse investment than the broad market? Well, if you're looking at a relatively short period like 5 years, the broad market has performed much better than the banks. But if you look further away, almost every bank except Bank of America has performed worse. But we also can't forget the relatively high dividends that these banks pay out to shareholders. As of this video, JPMorgan Chase pays a 3.42% dividend, Bank of America pays 2.58%, Wells Fargo pays 2.73%, and Citigroup pays 4.24%. Compare that to the broad market paying a meager 1.45% dividend. Over the past 13 years or so, interest rates have been very low. When interest rates are low, banks don't make as much money because they usually lend that money out at also low rates. Now that interest rates are higher, banks can charge more interest when they lend the money out to customers. The inverse happens to the broad market. Interest rates hikes create a down market. If interest rates eventually normalize at 5% or 6% over a sustained period of time, you'll see banks making more money from their lending business. That means potential for more profits and a higher stock price. We can also look at a time before interest rates dropped to near zero. Let's look at the period from 1993 to mid-2007, when interest rates had an average of about 4%. That period peaked in 2000 with interest rates at 6.5% and a low of 0.98% in 2003. The broad market rose 249% during that 14-year period. JPMorgan Chase rose 287% during that same period, doing slightly better than the overall market. Bank of America rose 270%, Wells Fargo rose 519%, and Citigroup rose 1,036%. That means during a historically normal interest rate environment, all the big banks match or either exceed the gains made by the broad market. And if history can tell us anything, if interest rates can get to that higher level, we can see banks doing just as good as the broad market. But we'll see. There are plenty of other factors to consider, and there's always something that can change everything. So what are your thoughts? Do you own any of the big four bank stocks? Comment below. And as always, take care of your money.